Good morning. My name is Hugo Chance. I'm CEO of Chance Capital, and welcome to the first of our Talk VC events in partnership with Fladgate and London School of Business and Finance. I'd like to welcome our panel guests today. We have Jamie Hamilton from Fladgate, Nick Newbury from Original Travel, and Andrew Green from Rockpool Investments. Before I hand over to them to introduce themselves, I'd like to just give you a little bit of background on Talk VC and what it is. So these events were born out of really the need for practical advice from business owners, from SMEs that require information and insight from those who are at the forefront of venture capital within the UK. There are many courses and indeed resources out there for SMEs to learn about the academic support or reasoning behind growth capital, but there's precious little, we believe, in terms of that practical advice and insight, the nuances perhaps behind raising capital from a private investor compared to an institutional investor. And that's very much the premise of these events. So we aim to give you commentary and discussion along with a number of other resources over the coming months. Today we're gathered just as a panel due to the unfortunate coronavirus situation, but nonetheless we hope this content will be valuable and insightful for you. So first of all, introducing Andrew Green, who is Head Investments at Rockpool Investments. Andrew, would you like to give us a bit of an introduction, please?
Sure. So Rockpool Investments is a private equity firm. I suppose we're a little bit different because we don't have a fund. We get our funding on a deal-by-deal basis from high net worth individuals across the UK. We invest in UK SMEs, established companies, not startups, but businesses that have broken through into profitability. And we fund MBOs, one MBI, equity release transactions that allow entrepreneurs to de-risk partially, and also development capital. And our typical check size is £4 to £8 million. We've been going for about 9 years. We've invested over £400 million in over 50 companies. We're very active, and we're real passionate enthusiasts for growth investing and helping SMEs go on to the next level. And I've been there from the very start.
Fantastic. That's great. Thank you very much. Nick Newbury, Original Travel. Nick, do you want to give us a
Sure.
intro?
So I co-founded Original Travel back in 2002. Prior to that, I was an investment banker for just under 10 years, not in the travel sector at all. So I was in the telecom space and worked on many M&A deals, fundraisers, flotations, private equity work. So interesting from an advisory capacity. I then became the CEO of Original Travel, as I said, right from the beginning in 2002, and have been for 18 years. Funnily enough, actually at the end of this month, I'm stepping back from being the CEO of Original Travel. But I should point out it has absolutely nothing to do with the coronavirus. It's something that's been planned for a while. During my time at Original Travel, from a M&A and capital raising point of view, we have sort of post-founding, obviously we've raised angel finance, private equity finance. We've acquired a couple of businesses. We have exited our venture back as well, and we welcomed in trade investors at the beginning of 2017, a company called Voyage du Monde, who are the leading player in our space in the French market with about a 45% market share. And given my former background in corporate finance, I've tended to self-advise on the corporate finance side of things. Jamie's given me excellent advice from a legal point of view. And outside of that, I'm also, an early stage investor in various EIS type opportunities, probably the best known one being What 3 Words. So, yeah, that's me.
Fantastic. Well, many hats, and we look forward to rich discussion touching on many of those. And lastly, our partners and hosts for the premises here today. Thank you very much, Jamie Hamilton, who's a partner here at Fladgate. Jamie.
That's right. So I'm a corporate lawyer. Fladgate is a corporate and commercial full service law firm here in central London. I have a broad-based corporate practice, but with a particular focus on venture capital, other aspects of growth capital, and private equity. And in those spaces, I act for the full range of players, really, from institutional investors, private investors, high net worth individuals, to founders, investee companies, and management teams. And I'm part of the growth capital team here, which is across departmental and multidisciplinary team, which plays very well to our strengths. We have specialist lawyers working in technology, intellectual property, tax, employment, funds, and all the other key areas that companies in this space encounter. We're very enthusiastic about working with high growth companies. We're flexible in the way that we do that, and we tailor our advice to their needs. And so we're very, very happy to be here this morning.
Fantastic, and thank you again for hosting us. And then just briefly for my part, again, Hugo Chance, CEO of Chance Capital, and in a nutshell, we advise SMEs on raising typically 2 to 50 million Series A or B growth stage capital. We've raised just under 70 million across the 4 years that we've been trading, and we are largely agnostic in terms of the sectors that we look at for client businesses. And we have around 150 investor relationships, predominantly family offices, high net worths, going right up to institutional investors and alternative debt providers. So that's us. That's the panel. So moving on swiftly to the first question, and Jamie, I might come to you first of all on this one and work our way round. How would you say that the venture capital environment, specifically in London, might have changed over the last 5 to 10 years? What are the main themes you might have seen there?
Well, I think first of all, one would have to say growth, and I think venture has seen an explosion of growth in London, and year on year there are many more millions being invested and being raised, both by funds and by startups in venture in London. I think with that we see increased sophistication at all levels, and I think an increased specialisation of funds looking at particular sectors or companies at particular stages. Just before we sort of move on to everybody else, from a lawyer's perspective, we've also seen a big change. Venture used to be something that the big law firms would do a bit of, usually as a loss leader, actually, in the hope that if you do 10 such deals, one of them might one day lead to an IPO. And we've moved away from that towards seeing venture as a valid practice area in its own right, and there are dedicated teams who are doing great work in this area. So law firms are taking it a lot more seriously. Fantastic.
And Nick, you've been running a business really across that time scale, kind of last 5 to 10 years. So you've again been right at the coalface of witnessing those changes and being at the forefront of raising growth capital. What are the things that you've seen in that time?
I mean, I'll give you a few data points on this. So I don't know if you follow merger markets trackers on this particular area where they're looking. They're probably missing a number of deals, but they tend to look at any deals that are above the £10 million size. And I was looking yesterday just at how those have tracked since about 2009. Now, in the 2009 to 2013 period, you had in my sector, you had about 8 to 10 deals, of which 2 were venture-backed. In the 2014 to 2018 period, there were about 25 deals in any given year, and about 10 to 12 of those were venture-backed. 2019 was a bit of an aberration, largely Brexit related. There were only 8 deals, none of which were venture-backed. 2020 started phenomenally well. People were very, very interested up to about mid to late February, and obviously for obvious reasons in relation to Corona, that's completely quietened down. But I would expect that to return in Q4.
Very interesting, thank you. And Andrew, again, being with your investor hat on, you must have seen some fundamental changes over that time, or indeed the investor appetite, or their sector-wise, but also their appetite for different investments.
I think that's right. I think if I sort of think back to 2011 when we started, and the last 10 years, the number of players in the market has gone up. Exactly, following the earlier point, there are more funds, there are more individuals who are interested in getting their money into earlier stage and private companies. I think part of the reason we set up the business all those years ago was because we felt there wasn't access for individuals, and now you've got obviously Seeders and Crowdcube and these, all the crowdfunding things have come on leaps and bounds, and questionable sometimes the quality of some of those, but the routes of access are just vastly bigger than they were 10 years ago, which has to be good for the companies in that ecosystem. It has to be good that there are more people looking to put capital in and more people wanting to play in that sector. But I suppose with that comes also higher valuations, and that's the challenge from the investor perspective. Is as more money chases the same number of opportunities, you do see prices rising, and you have to be wary of that.
If I could just add one recent trend that I've noticed, it would be that this sector has been characterised by, as you say, very, very frothy valuations, and startups looking to grow and expand at all costs without really a view to sustainable profitability. And I think in the last year or so, we've seen a move away from that, actually. Yes, people are still looking for the high growth, but actually there's more and more of a focus on building a sustainable business.
I'd agree with that. I mean, I think there's a better understanding that I've seen. There's a higher level of scrutiny of those valuations. I think certainly we touched on crowdfunding, and we may well come back to it on a later question. But Nick, do you think that there is that is right, that there is a greater scrutiny even at that startup stage from retail investors, or do you think there's still a certain level of, dare I say, ignorance when it comes to piling in on high valuations?
Yeah, I think the scrutiny at a very early stage, clearly everyone's going to have scrutiny on all the investments they make, but that very early stage level of scrutiny is so difficult because visibility is so poor, and at that point you're really judging things. I would imagine as an investor, you're judging things on, is the product great, is the service great, and are the management great? And if it ticks those three boxes at that early stage, that's all you can judge things on, is my view.
And I think that that may well be one of the themes. The next question: what would you say are the biggest challenges faced these days by SMEs raising growth capital? Come straight back to you on that.
Yeah, I mean specifically right now, obviously, just post Brexit. Brexit's fully happening. Oil, Corona, US elections. Right now, it's very, very difficult, and I would be interested to hear what you have to say about that. But I think fundamentally, if the deal fundamentals are right and the business's fundamentals are right, it's not necessarily going to put off a deal. Jamie will remember we closed our verbal heads of terms the day before the referendum back in 2016. I suddenly thought, crikey, that's it. 10 days later, the deal was very firmly on, and I think if the fundamentals are right and you have a medium to long term view on a business, you're going to make that investment.
I think that's right. I mean, we're still progressing with the transactions we've got in heads of terms at the moment. Admittedly, one of them is a facilities management business, which seems to me to be completely immune to this. Never say never, but business that goes around checking compliance services in office blocks and so on. I think I think investors will. I think there is a risk of people sitting on their hands for the next few months. I mean, undeniably, you just want to see where the dust settles. But I suppose the more fundamental challenges are the ones you mentioned, which are the longer term things. What's going to happen, with the Brexit settlement. What's the outcome of those trade talks. What's going to happen between China and the US. Trade wars and so on. There's a lot of uncertainty. I do feel possibly we've seen best of the easy market of the last. It hasn't been that easy, but it's going to get a bit harder here. Which I think means for companies raising capital, they need to be even more focused on the. I mean, it sounds very trite, doesn't it? But even more focused on the fundamentals, which is exactly what's the business model, what differentiates them, and what are the fundamentals of the financials. And I think the days when you can just come in and say, "Here's a great idea, and we're going to lose $3 million a year for the next 3 years," are probably coming to an end.
Yeah, thank you. And Jamie, I mean, you might see this in some of the term sheets. I mean, there's clearly been this myriad of choice in terms of sourcing growth capital, from crowdfunding perhaps at an earlier stage to all the others we know about. Do the term sheets, from a legal perspective, does that make life difficult for SMEs in terms of understanding the intricacies? Some of them perhaps a little more punitive than others. Do you see that?
The answer is absolutely. And I think that one of the big challenges actually for SMEs, we've talked about attracting the capital, and of course that's a challenge. But in the end, there is a lot of capital to deploy here. But there are also a lot of different types, and there are a lot of different types of investors. And term sheets can vary massively and can contain terms that will have huge effect on ultimate value. So I think that understanding those is a big challenge, actually, and you know, it is not an easy thing to say that you should be taking professional advice at that early stage, because it often costs money. But if at all possible, you need to do that, and at least you need to make sure that you are understanding everything in that term sheet.
Yeah, absolutely. Unadvised management teams don't actually help the investor. I think we've had situations where whether it's the vendor in a management buyout or whether it's a management team themselves have felt they don't need to, or they'll go with their, not trying to puff Fladgate here, but they'll go for a local law firm where they live, the chap who does their conveyancing, and you need professional advice. If you can possibly afford it, take professional advice. Unless of course you're corporate financier by background, in which case you can do it yourself.
But I think regardless, the messaging there is pretty clear. I mean, and perhaps even more critical at that early stage of understanding, who you're getting to bed with, that the terms are understood by management, and that they're not going to, they're not going to get mucked around at a later stage, or there's some line they don't understand.
Look at things like leaver provisions, for example. You can have founders who end up not realising that they're stepping into a situation where essentially they can be removed and give up all their equity. I mean, these are really fundamental things that you have to understand, and the market's getting ever more complex in terms of good, bad, intermediate, circumstances, and so on. And these are technical areas. They need technical help.
Yeah, I think to pick up on a couple of those. I mean, the one of the real key features of venture capital is the liquidation preference, right? And you often see a term sheet that talks about, say, a one-time liquidation preference. Well, actually, that can mean all manner of things. And liquidation preferences come in all shapes and sizes. And whether the term sheet says participating or non-participating, that will have a massive effect on the ultimate value. You have to understand these things, and you have to negotiate them. But the one that I really always want SMEs to and founders to focus on at the early stage actually is dilution, and how much dilution one accepts in an early fundraise. I've often seen founders accepting too much dilution because they're keen to get the cash in, and then when they need to raise again, they've got nowhere to go, and they end up with too small a stake, which actually investors don't want a founder to have too smaller stakes. It's not incentivizing.
Yeah.
So, but paying attention to all these bits at the early stage is crucial.
And I think that's an interesting segue into the next question in terms of crowdfunding and the pros and cons of that. And it's still a relatively early portal for raising growth capital, and valuations and dilution is very much one of the critical sticking points, I believe, there, in terms of it being retail capital with X number of people putting in very small amounts, albeit perhaps under a nominated structure, but nonetheless valuations can be quite toppy, to say the least. And then there's that question of dilution. And if they then go on to raise another round, there's that threat of having to do a down round, because does it stack up? Have they hit those waypoints in terms of turnover and possibly break-even stage? So, Nick, maybe you want to touch on some of those concerns.
On the crowdfunding side of things, we'd got to a stage where perhaps if we were existing now, we may well have dipped into the crowdfunding space, but the stage we'd got to at the point that crowdfunding started, we'd passed it. So I can't speak from the experience of having either benefited from a crowdfunding investment or in turn made a crowdfunding investment. All I would talk about as a entrepreneur is the administration and hassle of having hundreds of investors. Do not underestimate the pain that creates. Equally, if you think about something like an angel club, you could be in a situation. I have friends who started businesses where they would attend, they would set up their AGMs, and suddenly there's an audience of 180 people who are showing off to each other. There are 5 or 6 people in there who've maybe come into a certain amount of money themselves, who want to demonstrate how wonderful they are in business, and the entrepreneurs sitting between as people are sort of showing off around them. I have to pass in terms of my experience of having received crowdfunding investment, but I would just make those 2 points.
I mean, it's interesting. I mean, I sometimes see businesses that have raised a bit of capital via crowdfunding campaigns, and sometimes it can be quick access to capital, expensive sometimes. But nonetheless, I found that when speaking to professional investors who are, deploying X million at that next serious stage of the raise, they don't always like the fact that businesses have done a crowdfunding round for that very reason. The cap table is very long, and valuations and all the other things that we touched on. Have you seen that?
We had a direct experience this a couple of years ago. Obviously won't name the firm, but we agreed heads, and it was a business being advised by household name accountancy firm, and the firm came back to us when we were going through diligence to say, actually, we're going to have to change the terms because they can't get the crowdfunding investor base to vote for the changes to the articles that we'll need to do this. So the company had gone out and negotiated a perfectly sensible, in our view, set of terms, and had to row back, and we pulled out because they had to. The crowd had to be managed. I can see why companies, particularly very early stage ones, go down the route, because it's the lure of that, exactly to your point, of not much dilution. You can get a very high valuation on the back of your brand or your concept or whatever, but you get no support. I mean, there is no support from these organisations. They don't purport to support you or advise you or help you. You're literally getting money. If it was me, I'd probably go for the angel. If it's a choice between angel network or pure crowdfunding website type thing, I would go for the angel, because if you get the right angels, particularly a tight group, not a mob of competing egos, but a tight group of people who know what they're doing, that can actually add some value.
Yeah, and in our case, we had an excellent angel investor, or angel club at the beginning, and accessing that network in terms of their understanding of a particular theme in digital marketing or a particular area of FX or whatever it happened to be was phenomenal, which you're not going to get, I don't think, from reaching out to thousands of crowdfunders.
Yeah, I mean, it's a question I get time and time again, and whilst we don't fortunately cater to that startup stage business, is where do I find these angel groups? But I think it is, Jamie, maybe touch on the legalities of crowdfunding firstly, but also the importance of networking and really milking your networking and speaking to as many people as possible, because I don't think the value can be underestimated of a strategic investor, so a single angel or perhaps a small consortium of them who can really add some gravitas to a business.
Yeah, I think that's absolutely right. I think there are definitely pros with crowdfunding, and we've talked about valuations. I think from a marketing perspective, it can actually be a really good news story. If you can see thousands of people sort of flocking to invest in your thing, it can seem like you've got a lot of momentum, and I think social media helps with that. I know when people advertise their crowdfunding on social media, it feels like their business has got lots of momentum. From a legal perspective, they're not particularly straightforward deals to get away. The crowdfunding platforms are heavily regulated. They need to do diligence. Actually, getting a deal away with one of them can be not a lot less intensive than doing it with an institutional VC. On the other hand, once the deal's done, as we've picked up, there isn't the support that you would get with a VC. Now, for some founders are certain enough in their concept and want to run their business without outside interference, actually. So there's different founders for different models. Some people might not want a VC's investor director on their board all the time. They might not feel that they need to dip into to angel networks, and so in that circumstance, it might be good. They can get on with it, and so long as they provide their monthly or quarterly report or whatever it is to the crowdfunding platform, they're largely left to their own devices. But I think for a lot of startups and growth businesses, taking advice from all corners has got to be helpful, so long as you've got a filter for that advice, and you can take what you need.
Thank you. I'm going to kind of merge the next two questions into one, because I think they're interlocked. What do you believe? Come back to you again, Jamie. Are perhaps some of the main stumbling blocks or challenges to SMEs finding growth capital? And again, we touched on it before, but finding that right investor. I mean, again, crowdfunding is one thing, but then find that right investor who can be strategic. Perhaps touch on those two things.
Yeah. I think there are lots of different types of investor who can bring different things to the party. It's crucial to ensure that you as a founder are aligned with the investor's idea. So you need to understand what they want with your investment. They are going to want an exit at some point, but what's their exit time frame? What's their return on investment requirement? Who are they thinking about exiting to? And does that fit with what you want to achieve? Also look at the other companies in their portfolio. Are there any there that are complementary to you that you can grow from? Look at their network. Who can they introduce you to? How are they going to help you grow your business beyond putting money in?
Fantastic. Nick?
Yeah, I would say, it's down to your needs at the specific moment that you're at. We've gone through an experience of having friends and family, angel investors. We've gone through the venture fund. We've gone through the trade stage, and each served their purpose absolutely, and were a huge benefit at each stage of that game. Common pitfalls, I would say, and it would be true of any of those stages, because it's wrong to underestimate the angel investor. They're sophisticated individuals. Is not having your house in order, and it's I come back to that point about good product, good service. A reflection of good management is going to have things like the boring but important stuff like corporate governance in place, and making sure that your operational processes and your board processes are in such a state that you can press go on a due diligence data room literally at the drop of a hat. Now, if you're an investor, irrespective of whether you're a late stage trade investor, venture investor, or angel investor, if you're able to receive that information in good order and in good form, and it's clear that that's been run for a period of time, then the due diligence process becomes a breeze. The speed of it being turned around becomes a breeze. There's no reason why a transaction shouldn't be able to take place in 10 to 12 weeks. And going hand in hand with that is coming from the point of view of an investee. valuations you'll receive and the multiples one could look at are going to be greater.
Very, very true. And Andrew, you at Rockpool, you source opportunities, but you also shepherd that process through with your consortium of investors. So you're covering several stages of that process.
Yeah, that's right. I mean, we keep the investor funding process very much away from the investment process. So we have the business split into two parts. But I think the obstacles that we see exactly to that last point are companies that can't produce the information that any reasonable investor is going to need are going to struggle to get investment. They just are. And if you say to them, give us your management accounts and there's no cash flow, that's going to be a problem. If show us the leases on your premises. I mean, I don't know where they are. But all these very fundamental things that sound very silly, don't they? But good data, good information, the ability to show you understand your business, realistic forecasts as well. The number of things we get sent where business is going to hockey stick and suddenly it's going to go from turning over 4 million to turning over 44 million in a year. No, it's not. Be realistic. Think about what you're putting out there to a potential investor. Because your credibility is connected to the numbers you can produce and the business plan you can produce.
I would add one additional point in terms of that chemistry thing that you talked about, Jamie, is that if that venture backer is putting a board member on your board, I would strongly recommend having someone who you feel it's really going to challenge you. The second that doesn't feel like you're going to be in a situation, the second you're walking into a boardroom going, well, this is going to be a breeze, forget it. You're not going to be, you need to have someone who's been on that roller coaster before and who's going to be able to, if you've got 10 points on your agenda and 9 of them are great reports and there's one thing that's got to be, you want someone who's going to stick their finger right into that hole and poke it and drive, and you want to be slightly sweating in there. I know that sounds slightly perverse, but that's the way you're going to drive your business.
Yeah, I think that's a very valid point. And coming back, question for you, Andrea, as an investment house. I mean, I see sometimes where often known as founders mentality, where they're somewhat stubborn in taking on new advice. I think it's a red flag to us if a founder or a management team don't necessarily have that humility to listen to different perspectives. Because if that's the position from an early stage, then when the business grows and bureaucracy perhaps increases, that could be a real kind of brick wall in terms of adapting to market conditions or whatever it may be. So that humility, is that something that you guys look for?
Definitely. I think the relationship point is so key as well. It's not quite like a marriage, because it's probably going to last 3 or 4 years. Hopefully most marriages go on longer for that. But it's akin, while you're in that 3 or 4 year relationship, you are stuck together. You're meeting each other monthly at board meetings. You're talking almost certainly far more than that. You've got to be prepared to accept criticism. You've got to be also, you have to get on with the person you're working with. I think that we were talking before the thing, weren't we, Nick, about when you went to meet your trade investor and you walked in and said, culturally and everything about it, this will help us. This will take us to the next level. If you don't get that feeling, you're probably looking at the wrong person.
Yeah, very much so. Jamie, any other thoughts on that, or are you in agreement with these guys in terms of that match and that the humility piece of a business?
I'm absolutely in agreement. Although I would say that it's a balance, and a founder has to be strong, and a CEO has to be strong and decisive and have his vision. A VC or a PE investor is not going to run your business for you. They'll challenge you, but you're the one who's driving it, and you're the one that they're relying on.
And I think that touches very well on the next question in terms of the differences and the fundamentals between raising growth capital from a private investor source, so a high net worth, a family office or similar, compared to an institutional investor. Coming straight back to you, and just going off your last point, the strategic input perhaps is very different from a high net worth. And I know a lot of institutional investors say, we help and we support them, and then we have all these other portfolio companies that they would dovetail well into. And is there a kind of somewhat genetic commentary on that front, or do you think that genuinely some institutional investors can be as helpful and strategic as private investors?
I absolutely think that institutional investors can be as strategic and helpful as private investors, but I think it will be with a different perspective, because an institution is focused on its exit and its returns and getting the business to where it needs to be at that point. Now, it's got to be more long term than that, because you're not going to get a good exit away if the business has plateaued. And so it's got to be with an idea towards long-term and sustainable growth, but that's going to be their motivation. Whereas a private investor may become more personally attached and emotionally attached, may not have the same exit aspirations, may be more happy to align with what the founder wants to do, actually, and may be able to bring some of their career experience to bear.
And again, just a slightly different question. Do you see that the term sheets are perhaps a little more punitive from an institutional investor compared to a private investor?
Absolutely. Yeah.
So obviously, again, that need, the point we touched on earlier, that need for getting professional advice when doing the legals is ever more important when perhaps you do raise capital from an institutionally type investor.
Yeah, and I think that due diligence also shouldn't be underestimated. If an institutional investor gets something wrong, they have to answer to their investors, and their best way of protecting themselves in that unfortunate situation of being challenged is to show that they did thorough diligence and they left no stone unturned, and that their decision to invest was demonstrably reasonable. Whereas a private investor, if it all goes wrong, has only got to really blame themselves. Yeah. And doesn't have anyone else to answer for. So you can often see private investors being more ready to take a view on things, being more ready to look for upside and not be so persistent about turning over every stone.
But an error that an early stage investee company can make with a private investor is to assume that they're somehow less sophisticated, less informed, that they want less of a due diligence process, and consequently the company thinks, well, I can wing it here. No, adapt to your audience, but don't go anywhere near condescension. You start at the institutional level, adapt accordingly, but have the same. It's the same message whether you're talking to, a wealthy individual or a full-on institution.
And Nick, have you found that that process of pitching, and maybe the same messaging, but pitching to private investors compared to institutional ones, is there perhaps more of a tick box approach from an institutional investor in terms of turnover, EBITDA, etc., or is it more or less the same?
No, I think the audience tends to be, it may well be the person you're speaking to, or the private family office that you're speaking to. Their day job is in an institution, or their day job used to be in an institution, so they're going to ask you the same questions. I don't have the experience of going out and speaking to a family office, for example, from a pitch point of view, but I speak to many young businesses that do, and I'm astounded that they would consider that they could, as I said, inverted commas, wing it.
Andrew, any thoughts?
Yes, I'm obviously going to speak up for the institutional investor over the private. I think, certainly speaking for ourselves, we've taken a lot of companies through that life cycle. Now, it is focused very much on the exit, but in some ways that's what the management team or the entrepreneur needs as well, because they're taking on investment to go to the next stage, and they need to know what that next stage looks like. And they probably don't know what it looks like. They know what growing the business looks like, but they don't know. Take something like reducing value drags. A drag on future value, customer concentration. The entrepreneur's probably thought, this is amazing, I've got this one fantastic customer who's helping drive my business, and he doesn't realise that actually, while that's fantastic, they're 60% of his business, and that is a huge drag on his prospective value. And one of the main things he or she should do is try to diversify that base. Probably sort of feels a bit uncomfortable having one big client. But, it's working with the team on all those value creation levers in the next 3 or 4 years. And I'm sure there are some really good individual angels or high net worth investors who can do that. But I think an institutional house hopefully has the edge in being able to help guide through the next 3 or 4 years.
Very interesting. In terms of failures, and we all fail, and in fact, it's an important part of the development and the cultivation of any business is learning from those failures and adapting to them. Nick, coming to you, what would you say, cards on the table, biggest failure or learning curve from things perhaps that you've not done quite right?
Get advice early. It may seem expensive, but it is worth every penny. Don't just assume that you can do it all yourself. Now, I know at the beginning I said, provide my own corporate finance advice. I'm going right back to very, very early stage and just assuming that in a small team of 3 of you, you used to have a bit of X, Y, Z skill that therefore you should do that for the business. You're therefore pulled away from growing the business. Find the capital to make the investment, to speak to the accountant or the lawyer or the advisor that's going to help drive this thing forward, because it is worth every penny.
Jamie, any thoughts on
that wasn't big
failures?
You up, by the way.
Sitting in the Fladgate offices. No.
Well, from a lawyer's perspective, the one of the biggest learning curves that I have had to deal with in this area is striking a balance between protecting your client's interests and becoming a roadblock to a deal. It's very easy for parties to have struck a deal and shaken hands and got a nice head of terms, only for the lawyers to come in and make it difficult. And lawyers get blamed for this sort of thing all the time. And ultimately, if we end up, there is a balance. Of course, we're going to make it difficult because we're trying to protect our clients' interests, and there's lots of details that aren't gone through at heads of term stage. But ultimately, if we end up materially slowing down a deal or even scuppering it, we're not acting in our clients' best interests. And so that's something that it's taken me a lot of transactions to get towards striking the right balance. In terms of companies and startups that I've seen, areas where I think things have gone wrong, I would definitely say that raising money at too high a valuation early on, I've seen that being terminal actually to businesses. Having to do down rounds later on, especially when you've taken money where there's investor down round protections in your first round, can be terminal for founders' equity, and you can see people ending up getting swamped and having to do restructurings which are damaging, and also accepting too much dilution too early.
Andrew, biggest failures or learning curve from a Rockpool perspective, or indeed businesses that you've seen?
I think from our perspective, sometimes not making management changes in invested companies early enough. I mean, you back a team, you think they're the right people, and then things don't go to plan. And I'm not saying you should immediately get in and change everything, but I think sometimes we've been a bit reticent to make those changes. And actually, all businesses are about management, aren't they? But SMEs are particularly about management. They don't have the corporate structure of larger organisations. You're reliant on normally a key 3, 4, 5 people. If one of those people, if the finance director just isn't up to it, change it. And I think that, that's both from the investor point of view and also from the rest of the management team's point of view. Everyone knows when the team isn't quite right, but there's always that tendency, particularly young businesses, where you've gone on that journey together to go, oh, well, yeah, he's okay, and we'll sort of push him in the right direction, but make changes more quickly.
In terms of the tax breaks, we all know about the Enterprise Investment Scheme and its little brother, the Seed Enterprise Investment Scheme. How relevant do you think that still is? Do you think it is likely to stick around? I'm continually surprised by the number of businesses who are at that later stage or the Series A or B stage who have never heard of it or don't know what it is. I mean, it's crazy. Clearly, for a UK taxpayer, it's a huge incentive to invest in earlier stage businesses. Jamie, how relevant is it, and how much of a help is it for investors and businesses?
I think it's a massive help. I think the EIS and SEIS reliefs are fantastic, actually. And whenever I've been abroad and talked to contemporaries and people in this type of climate in other countries, they're always amazed that we've got something as kind of far thinking and helpful, focusing on growth companies as this. I think there's a prevalence of funds that are offering this. Companies are talking about it all the time. I think there is a danger of it being a double-edged sword, actually, sometimes, because you can see companies at an early stage when they should be focusing on their businesses, focusing on the fact that they offer that they're EIS eligible. And I think the other thing is I have seen it distorting valuations, actually. If an investor is going to be saving 30% of his or her upfront investment, then you can see a company pricing that into their valuation. I actually saw a company recently where it was refused advance assurance for EIS, and it had to drop its price in order to persuade investors still to invest. Which, when you then start thinking about down rounds or future raises, where EIS won't be on the table because they'll have gone through the limits, having to readjust and take that out can then be damaging. I think it can contribute to some of the frothy valuations, actually. So yeah, overall, I'd say it's fantastic, and when used in the right way, very, 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 very helpful. But some caution needs to be exercised, and it needs to be used in the right way.
Yeah. I've seen the same, Andrew. Have you?
Yes, I mean we started off as very much an EIS house, and as the rules have changed and the 7-year rule came in a few years ago, we've moved away from that, and probably now 1 in 5 or 6 of our investments will be EIS qualifying. But actually, I think often people don't know there are other tax benefits even for companies that can't get EIS for individual investors who want to come in. So, for example, loss relief. I mean, one of the great advantages of EIS, if it does go wrong, you can claim losses against income tax, not just against capital gains. That actually applies to a whole wide range of private companies that are not EIS qualifying, up to a higher of, I think, 50,000 or 25% of your gross income in a particular year. And although entrepreneurs relief, we're talking the day after the budget, aren't we, got abolished, there's this very little known thing called investors relief, which is still out there, which says that if you hold as a private individual, if you hold shares in a company that would qualify for EIS because of its sector for 3 years, and you subscribed for them originally, you didn't buy them, you only pay 10%. So and then there's BPR, business property relief, which applies. So actually the whole tax approach to investing in UK private SMEs is actually quite attractive generally. But absolutely right. If it then means that you're overpaying on valuation, then the whole thing's gone the wrong way around.
Mm-hmm. Interesting. Nick, do you think that there is? Do you think that people need to be informed more about EIS, or indeed a number of the other reliefs that are out there? Or, I mean, there seem to be. I was
surprised actually when you said that you come across people who don't know about it. I mean, it's been
around for a while.
Yeah, I don't know when it actually started, but it's been around since the day we started in 2002, because early stage investors in original travel were EIS. I mean, there wasn't SEIS at the time, but there's EIS. And if you think about the political environment and the governments that's been through, it feels to me like it's something that is here to stay. And to your point about entrepreneurs relief yesterday, I suspect there'll be entrepreneurs who will be looking to see that tax benefit in some other shape, way, or form, and so
they also announced a review of the EMI, Enterprise Management Incentive, a review. So, but it sounded quite like a positive review, and there was Fladgate's view on that was, but it was like to try to expand it or make it more widely available to management teams. So there could be some good news coming on that front for management.
Very interesting, and I think then that coming on to follow-on question, and indeed our penultimate question, do you think that London's prominence as really the kind of European hub of venture capital is going to stay with the eve of Brexit and the ramifications of those changes coming into effect over over the coming years. Do you think that it could be a blessing or a curse, Nick?
I would have thought yes. Again, I come back to the point: if the business fundamentals are right, an investor is always going to look to invest. I'm absolutely a Remainer. I'm half Danish. I'm married to an Italian. I run a travel company, and our parent company is a French company. So I was very sad about Brexit, but it is what it is, and one gets on. And I don't think the city is going anywhere. I suspect other European countries may well get a little bit more sophisticated. To your point about concepts like EIS not existing in those countries, I could see other countries getting a bit more sophisticated as they look to try and lure people and businesses away from the UK. But fundamentally, I think if the business is right and the product service management again is right, the investor's going to invest.
Jamie, I mean, clearly there's all sorts of regulation that needs to be ironed out and so on and so forth. Yeah. But from a legal perspective, are things up in the air at the moment, or do you think that this, from a legal perspective, is going to be a hindrance, or perhaps it could be a huge opportunity?
Well, you're right that everything is up in the air for good and bad. I think my view of this is London has done very well as a hub for venture capital because it's provided a lot of the key things that startups need to grow. So access to capital, access to talent, access to markets, a benign regulatory and legal environment, and a network of professional support. I think London is a world leader in all of these and always has been. I don't see Brexit as helping any of those, frankly. But I think that there are, and I think that the access to talent point is probably a particular concern. At the moment, we have a lot of EU nationals who are brilliant software developers working in London who are building the next big thing. On the other hand, I do expect this sector to be quite resilient, actually. Firstly, there's a very strong base. Secondly, there are measures like there's this Tech Nation visa, talent visa, which is one of the world's most generous, actually, which from an immigration perspective should, we hope, allow these knowledge-intensive companies to retain that talent. We've got top universities who are top research universities who are producing this type of talent all the time. But also, I'd say that startups are should be less dependent on existing and long-standing trade relations and more ready to look globally from the outset. So I think that Brexit should encourage startups to look globally, not just to the EU. And so I'd expect this sector to be resilient. And I think that to the extent that the broader economy and the stock markets suffer, investors will look to alternative assets like venture for their gains and their returns.
Interesting. Andrew, do you think it's a case of keep calm and carry on from Rockpool?
I tend to agree with the guys that I don't see any upside from it, and I think particularly on the immigration thing, this idea that if you can get on a plane at the moment from Berlin and come over here and just start working off from Madrid, and that's going to suddenly have a whole range of bureaucracy put between you and the ability to do that is very negative. The UK does clearly still, on the legal system, the ease with which one can start a company, the Companies Act structure that is so well known and concrete and provides a fantastic legal framework for all the board governance and so on that companies need. That's all still there. The legal system is still here, and we'll get through it. But I don't see any great upside.
Yeah, I'd add a couple of key things actually. Quite flexible labour laws here. And also robust protection of intellectual property, just crucial things for knowledge-intensive early-stage companies that we have are very, very well established in this here.
And thank you. And for our last question, again, it dovetails fairly well. We sit here in a somewhat difficult time with health issues with the coronavirus, etc., and we all hope that will be overcome in the short to mid-term. But also more specifically the turbulence, and to an extent because of that, but also because of oil prices in the public markets. Do you think that? I mean, I've seen just in the last few days it affecting some of the opportunities we're working on. But do you think that actually there could be an opportunity for venture deals, more specifically off the back of turbulence in public markets? Do you think that it's going to affect investor appetite on a across the board, or do you think it's a case of bunkering down and just holding out until investors appear again? Nick, difficult one, I know.
Yeah, very difficult. It's the catch the falling knife thing, isn't
crystal
it?
ball gazing, but
it's I would expect. I mean, I'm talking from our sector particularly, but I would expect things to be very quiet for the coming months, and really thinking now forwards to almost Q4 before things start to pick up again. Now, I would expect things to start picking up again when we're through this corona issue. That is the fundamental one that's out there at the moment. I'm not in for a second belittling oil and Brexit and markets and elections in the US, and all those things are clearly very important. But corona is dominating everything. Thinking about it from a venture point of view, funds have got to invest. You guys aren't going to make your fees unless you invest your funds fundamentally and bluntly. So venture funds are there's a lot of money out there, and it's going to be looking to be invested in businesses when the time is right. But I would imagine, and it's just my own view, I would imagine that's probably not until Q4 of this year.
I think at the moment everybody thinks, and probably rightly, that this is what we're going through is a short-term, what economists call an exogenous shock, not a fundamental collapse of the global economy. The banking and the financial services sector is in a far better position now than it was in 2008, where obviously it was the cause itself, was enormously over-leveraged, and we're sitting on a whole load of very, very dubious loans. I think central banks are better now, more activist. The governments are probably more activist than they were in the financial crisis. So, assuming that it is a the famous spike and then tails off, then I think that's right, that you're going to see a quiet period and then things will come back. So optimistic.
Jamie.
Well, I think if we look at China, where the coronavirus originated, and which is a global hub of venture capital, that saw a massive drop in deals, something like 64% down early this year. And I mean, I've seen deals being postponed, deals that were at head stage being postponed while this gets over. Meetings are being cancelled all the time or are being moved online, which reduces networking opportunities, which reduces connections. So I think we are definitely going to see a short-term slowdown. On the other hand, I was quite struck by the surge in activity that we have seen since the UK election in December, which was seen as positive for the economy. And actually, for the last 3 months since then, we've seen a great surge in activity, which gives me confidence that when we can get through this, there is an underlying market there of bright founders and driven people and startups that are going places and investors willing to put the capital in, that is there and that will come good when conditions suit, when conditions permit.
Very good. I think just in terms of closing thoughts, and may ask you each to give, if you can, maybe a kernel of an idea or a soundbite, if you will, to any small business owners who are watching this, in terms of practical advice. And we've covered a whole range of topics today, and again, we sit in a tough time at the moment from a health perspective. But personally, I see, again, off your point, Jamie, there is huge opportunity, huge challenges as well. But nonetheless, it's all to play for. there is a rich investment need out there, and there are many investors, and indeed London is still seen as a significant hub for investment in the UK. I think from my perspective, it's fail to prepare to fail. That messaging of what Nick touched on earlier was you must have all your documentation, and how you're going to pitch the process should be no different from one investor to the next, but it's making sure that you are living and breathing your business and you have that confidence to deliver, and not going into meetings semi-prepared. Andrew, any final thoughts on?
You summed it up very well. No, I think that's absolutely right, and I think to mark yourself out from the ordinary, you have to have some vision of where you want to take it, and try to think beyond the next year. Come along and say, look, we're doing this at the moment. We can do that and that and that, and bring a palette of possible growth opportunities. Think long term. Think over this bump that we're going through.
Yeah, and I would say for those people out there who are starting now, there is actually a massive opportunity in now. Don't lose heart, because again, talking from my own experience, we started straight after 9/11 when oil was all over the place. Iraq 2 was in full swing, and it was something where you can, whilst everyone else is paddling like crazy, who's actually active in the markets, paddling like crazy to manage the crisis, you can make enormous ground up on the competition by getting your house in order and using this opportunity to research and say, okay, fine, we may need to delay our launch by 6 months, but this is a wonderful opportunity because we don't have the pressure now of trying to operate in this environment. So treat it as an opportunity, don't lose heart, and push on.
Thank you. Jamie?
I've been struck by what Nick's talks about with the networks of investors and entrepreneurs that you've been a part of, and I would say that there are a lot of these that operate at all the different stages. So my advice would be to take advantage of those. Go and meet people who are doing the same thing as you, who've been through the same thing as you. Take feedback from them, and work out where you want to go. But most importantly is don't take your eye off your own business and your own vision.
Fantastic. Well, look, I'd really like to thank you all for being here today and chatting over a whole range of topics. Andrew, Nick, Jamie, thank you so much, and also to Fladgate for kindly hosting us, and executive education part of the London School of Business and Finance. We will be running additional Talk VC events over the coming months. So stay tuned. Thank you very much.